Okay, our top-down approach to market, industry, and company analysis. Yep. So market analysis we also call macroeconomic analysis. It's a bit like that term systematic risk. When we're looking at risk in corporate finance, systematic risk is the risk of the market, the risk of the economy doing well, doing badly in the country where a company operates. Okay, top down, first stage, a macroeconomic analysis of the relationship between the securities markets and the economy. Yeah. Okay. So, what's the relationship between an economy and corporate success, or corporate as measured by corporate profits? Well, not surprisingly, as the economy grows, more goods and services are produced. Those are largely produced by companies, private companies, and companies do well when the economy is growing fast. Yeah, so corporate profits and GDP here tend to be moving along together. And to some extent, corporate profits here are outpacing GDP, the dots. And of course, what's the main motivator for a higher share price? Share prices reflect profitability, don't they? If profits are high, share prices rise. If there's a forecast profit increase for a company, the share price will jump. What's been happening on the share market recently? Oh, online retailers are dropping by 10 or 15%. They've done very well during the COVID period and risen 30, 40, 50%, but their times may be up as we have COVID vaccines coming into the market. If the COVID crisis is going to end, then some of that desire to use online retailers will be replaced by people going face-to-face to shops. Okay, so just an idea of how dividends and stock prices can go up when the economy is doing better, and especially the market multiple, that the price earnings ratio will reflect tends to grow. Here it's growing from 14 times price earnings, 16 times. Yeah, so the price goes up again. So, yep, economic growth leads to higher stock prices, which, when you think about it, is pretty obvious. Companies produce more, do better, are more profitable, and greater profitability sees stock prices rise. Okay. So we need to look at some industries and some macroeconomic variables that are indicators of where the economy is going. Economic indicators, signals of where the economy will go, either up or down. Sentiment indicators, these performances of economic variables only happen when people are feeling good about the economy and they're spending their money and doing lots of purchases. And of course, interest rates is a big key to the economy. Okay, what are leading indicators? Yeah, economic statistics that tend to show us whether the economy is peaking or hitting a bottom and is getting ready to move into a new phase. To some extent, construction is a kind of leading indicator. Yeah, coincident indicators, they are macroeconomic variables that occur at the same time as peaks and drops in the business cycle. So they kind of confirm the business cycle. And lagging indicators are indicators that follow the economy, follow from behind. They might be 6 to 12 months behind the economy. Yeah, lots of good diagrams on this stuff. So what have we got for leading indicators? Okay, average, and this is from 40 or 50 years of experience observing these variables in the US economy. Average weekly hours, manufacturing or the amount of manufacturing, new orders, average consumer expectations, that would be consumer sentiment, a measure of consumer sentiment, interest rate spread, how much the interest rates in the market are above the US Treasury rates, manufacturing new orders, consumer goods and materials, credit index, manufacturers' new orders, yeah, stock prices in themselves are an indicator. I mean, if a country goes through war and very bad times, what signals the fact that the economy is likely to pull out and make a recovery from this downturn? Yeah, what we're saying here is, oh, new orders for the country's manufacturers. Yeah, new orders for consumer goods. Okay, average weekly initial claims for unemployment insurance is a leading indicator of what's going to happen in the economy. If it's new claims and people are going on to unemployment, it means they don't have money to spend, and that could be a problem for the economy down the line. Building permits, as we said, new private housing units. Yeah, leading indicators. Okay. Yeah, we can put them together into a single index, as the Conference Board does, leading economic indicator. Okay, leading, coincident, and lagging indicators. We're up to now coincident. Statistics that tell us where the business cycle is at the moment and moves along with the business cycle. Employees in the non-agricultural sector, personal income, creation, industrial production, and manufacturing and trade sales. That's a good indicator of today's performance of the economy, where the economy is now. Okay, and that's an example of these indicators, these three indicators. And lagging economic indicators. What economic indicators follow behind the business cycle? We have a boom, and these things peak 6 months after the boom, 3 to 6 months after the boom. Yeah, consumer installment credit outstanding. Yeah, inventories. Commercial and industrial loans. Yep. So labor cost per unit. Yep. These factors tell us what's happening after a boom. Great. No perfect indicators. Yeah. But we're looking for turning points in the economy. However, occasionally some of these indicators can give you a false signal. Yeah, we're always revising our data, keeping it up to date. And yeah, we've got to make sure it's as broad covering the economy as possible. Consumer expectations are considered to be a forward indicator because consumer spending is 60 to 70% of GDP. So if consumers are optimistic, they're going to go out and spend and create a boom. And different kind of surveys exist in different countries. Here in Australia, we've got the Westpac Consumer Confidence Survey. Okay, so there's an indication of the Consumer Sentiment Index issued by the University of Michigan. And those darkly colored bars across 5 bars across the diagram are recessions. Yeah, downturns. Last one being the GFC. So what we're saying here is, yes, the economic indicators tell us when the economy is doing badly. Yeah, so one of the most reliable indicators of what's happening in the economy are interest rates. If the economy is booming and there's too much economic activity, interest rates will tend to be high. If the economy is slowing and there's not enough economic activity happening, interest rates will fall. Okay, we're talking here about US rates. We're talking about here what is the cash rate in Australia. I wouldn't get too much into US interest rates. If you can, substitute the Australian situation. Okay, real federal funds rate. Yep. Rose a lot in the boom of the early 2000s and has been low since. Yeah, interest rates. We're also very interested to see what's the term structure of interest rates. This will actually be something that's in your final exam. The term or time structure of interest rates. How are interest rates for 1 month? How are interest rates on overnight money? How's interest rates for 3 months, for 6 months, for 1 year, 3 years, 5 years, 10 years? Yeah. That tells us about what's happening in the economy. If people all expect interest rates to go up in 1 to 2 years, that means the economy is going to head into a boom, and that boom is going to end fairly quickly because it faces very high interest rates. Okay, there's a diagram of interest rates, and the recessions are those darker shaded bars there. And in a recession, well, before the recession occurs, we have a boom. And in the boom period, interest rates tend to rise. In the actual recession, interest rates come down to make money cheaper to stimulate recovery. Analysts look at the risk premium on bonds. Yeah, how much they return. Okay, we've got interest rates very high in the 2008-2009 period and very low as the economy tries to recover from the global financial crisis after that. Yeah, we won't get too much into too much detail here. Yeah, our free cash flow method of evaluating companies, that's what we're going to use at the company level. And we're going to get into a lot of detail on that, but possibly not today. That's really going to be our focus from here on. Okay. Let's take a break. And we'll come back and have a look at industry analysis. Yep, so Mia, good to see you. We're trying to have a look at getting you ready for your presentations next week. We've got some slides up on learning experiences. Section 5 is all about how to structure your slides presentation for next week. No, Mia. Let's have a talk about it. Okay, everyone, take a break until 2:35. Okay, break until 2:35. We'll have a look at industry analysis. Yeah, have you got any thoughts? Okay. Yeah, sorry. Yeah. Hot day today. Very hot day. Ian, we're going to do something on yours topic soon. And Mia, did you see the slides from week 5 about the presentation? Let me just show you those, these ones here. Yeah. Okay. This is in Learning Experiences week 5. Just a bit of a guideline, some very general points about your presentation. We can always have a chat about that later. Okay, so let's go across. We've had a bit of a talk about industry analysis. This is going to be more important, the macro industry analysis, the macroeconomic and industry analysis is going to be more important later on as we move towards week 10, but we've got some other material to give you there. So we're just really introducing this now. Whoops, I've lost my slides here. I'm just going to have to come out and go back in. Okay. Yep, that's where we want to be. Okay, just moving to screen share here. Right, guys. Industry analysis. We're doing a top-down analysis. Mia, we've started off with which economies are worth investing in at the moment. Economies are doing well and booming or turning the corner from a downturn and getting ready to expand. Okay. That was the market or macroeconomic analysis. Once we've found a couple of countries whose economy is in the right stage, the economies are doing well, then we need to move to industry analysis. Okay, we're over here in learning content, week 5. Let's have a look at industry analysis. Yeah,